Good afternoon, ladies and gentlemen. Thank you for joining us. We are excited to bring you our 6th installment of our Health and Wealth webinar series. And I have the pleasure and honor of introducing my sister, my co-CEO sister, Abby Reed. I am April Cruz, for those of you who don't know me yet. Very nice to have you with us this evening. Have the pleasure of working with both my sister and my father this afternoon on this webinar. And Abby and I are very excited to feature Gary Reed. This is a discussion that he has become very well known for, not only throughout Reed Financial Group, but actually on a national level. This is an area that he's specialized in for quite some time. And we're excited to have you with us this afternoon. Abby's going to lead us off and get started on some materials. And thank you again for joining.
Thank you very much, April. It is great to be with everybody today. We're really excited about this installment of our webinar series. This is, like April mentioned, a very special edition with our dad and founder of Reed Financial Group. So we're excited to have him on, and you'll probably see somebody behind the scenes controlling the PowerPoint and doing everything makes us look as as good as possible, and that's Daniel, who is our COO and also April's husband and dad to my 2 amazing nieces. So just wanted to give him a shout out. He is invaluable with all the behind the scenes things. So it is about right on time. So I know that we all have a million things to do these days. So let's go ahead and just jump right into it. If you have any questions, just hold those till the end. We're gonna let you know how to ask those questions. April will talk about that at the end. So if you have questions, just write them down, and we'll be letting you know how we can address those questions. So let's go ahead and get started. Some of you that are clients know the term lazy money. We've talked about it before. We've probably addressed it in your portfolio. But for those who don't know, I want to give a brief kind of introduction on what we're talking about today, what all the different facets are with lazy money, and then get into some specific real-time, real-world examples. Kind of the lazy money hall of shame right now is what I kind of like to call it. So lazy money is going to be any money that are in accounts that are earning below historical or typical inflation rate. We'll talk a little bit about that in just a little bit, but this is also money that's not allocated to any particular expense or need. And the term allocated, what I mean by that is it's not set aside for anything. So it's not an emergency expense account, which is really important, obviously. It's not set aside for a child's wedding or a boat purchase or anything like that that's coming up. It's just sitting in an account for various reasons, but it's not allocated to anything. So it's just sitting there, and like we're talking about today, being incredibly lazy. So let's go ahead and go on to the next bullet point there, Daniel, please. A couple of areas to look for lazy money. I know that most people, when we educate on this topic, go right to their portfolio afterwards and try and look and see, do I have lazy money? And it's nothing to be ashamed of. It's pretty common, especially these days, but we'll give you a couple of tips on where to look for the lazy money. So we're going to be talking about today about the safe vehicles. So vehicles like CDs, money markets, checking accounts, savings accounts, even 401ks or IRAs that kind of are out of sight, out of mind. Maybe you haven't checked on them in a long time. There's a bunch of things that we're doing these days. So things like that kind of go a little bit to the back burner. So those type accounts, they can definitely have some lazy money in them. And also sometimes there's lazy money actually in our investments. So they're in our 401ks, maybe that we even have looked at, in our retirement accounts, in our investment portfolios, that are in unmanaged buy and hold bond type funds. I'm going to talk a little bit more about that and how interest rates going up or down really affect certain bond funds. We'll talk about that in a little bit as well. And then something else that we don't really talk about maybe as much, but it's retirement income or really income in general that isn't increasing. And Gary will go into a little bit more detail about why that can be so detrimental. Things that are not increasing, keeping up with inflation. These types of vehicles have historically served an important function. They used to return much, much more. I remember my grandmother telling me a story, this was probably 3 or 4 years ago, where she saw in the paper a CD at a local bank that was, had an interest rate of like 14 or 15%. So of course she ran right to the bank, put some of her money in a CD, and she was, happy as a clam because it was safe. It was earning, double digits. We can't even imagine that anymore. But these are used for a reason. People want their money to be safe. They don't want too much in the stock market. There's a lot of different reasons for these type things to be used. But how safe are they? That's what we're going to be talking about today. And how safe are they going to be not only in 2021, but going forward? What are the risks that are associated with this safe, potentially lazy money? So let's go ahead and look at 3 current real life examples of some seriously lazy money that we've come across recently. So this one, you don't have to read this, don't worry. I just wanted to put this up kind of as a reference. I had this brought to my attention. This is from TIAA CREF. So those of you that are teachers or some government employees might have a TIAA CREF account or had one in the past. Very common with teachers. By the way, thank you for all the teachers out there. We have a lot of clients and a lot of friends and even some family that are teachers. It's Teacher Appreciation Week, so we just wanted to give a shout out and say, thank you for all that you do. So TIAA CREF is one of the largest retirement systems in the country, and they just sent out notices recently. They actually have a whole campaign about this, about potential negative interest rates, negative yields in their money market funds that are available in several of their different accounts. So how could this happen? We've all heard a little bit about negative interest rates, but this is a real life example of that actually happening. So this is talking about, I'm not going to get too much in the weeds, but this is talking about how the Federal Reserve slashed rates last year. So that was done in March to help combat what's happened with the coronavirus. They do that for various reasons, but it was really done at this point to help with the volatility, those type things. So rates were starting to normalize after a pretty long period of them being below the average. So they were slashed even more. They were slashed to historical lows, lower than we've really ever seen in the past. And that has presented a problem for these type money market funds, which a money market fund is basically a cash-like mutual fund that allows people that don't want that part of their portfolio or that part of their money to just kind of be on the sidelines, earning what used to be a fair rate of return, just kind of sitting there for safety reasons or whatever their goals are. So that's what I'm talking about when I talk about money market funds. So what's happened with the really low interest rates is that the expenses that are in those funds, they are not going to be covered now by interest rate that they earn in that fund because they are so low, basically zero in some cases. So what this company did is they were able to agree with the government and kind of do behind the scenes things and have a waiver that waived the costs of this money market fund for as long as possible. They were hoping for interest rates to go back up, but the waiver actually expires on June 30th of this year, which is actually April's birthday. So it's easy to remember. So that waiver is going to go away on June 30th. And it says right here that the money market funds in several different accounts that are offered by this company, as well as potential money markets funds that are in other companies, other 401ks, investment accounts, things like that, may still experience a negative yield. So what they're suggesting is go take a look at this and just be aware that you might actually be losing money in that safe fund that you have. This was something that I've never seen before. It really seemed unprecedented as it's kind of the buzzword these days. But this is an example of some serious lazy money, maybe even more than lazy, because it's actually going to lose money while it's, quote, safe. So if you have if you have a TIAA CREF account or really any other money market fund that this might affect as well, now is the time to start making a plan for this, because the last thing you want is your, quote, safe money to be losing money. That's just not, we don't want to settle for that. The next really real life example of some serious lazy money, I know that probably most of you are familiar with what CDs are. My dad has a nickname for them, so but I won't steal his thunder. I'll let him talk about that. But CDs right now. So I wanted to just kind of take a look and educate everybody on what the landscape is for CDs right now. So what we did is we pulled up the national average for terms anywhere from 1 year to 5 years to see kind of what we're working with right now. So let's take a look at those. So we have a 1-year CD that's paying on average 0.18%. That's it, 0.18%. 2-year, a little bit more at 0.23%. 3-year, 0.26%. 4-year, 0.27%. And a 5-year at 0.32%. Not even a half of a percent, even if you go out for 5 years. I actually saw a special promotion on Facebook the other day of a CD that's offering 0.65%, and they were making a big deal out of it and had a big, marketing campaign and, all of the hoopla surrounding that. And I was looking at the comments and just how disgusted some people are at that and how disappointing that is. That's a special rate, 0.65%, and it wasn't guaranteed for very long. So what we're here to talk about today is that you do not have to settle for less than 1% in a CD, and you absolutely should not have to settle for that. Let's go to the next real life example of lazy money, and this is one that we don't necessarily think a lot about in terms of lazy money, and that's bond funds. So what I want to do is kind of educate a little bit about what happens with bond funds with interest rates. So interest rates and bond funds have an inverse relationship, which means if interest rates go up, existing bond prices and bond funds and bonds go down in value. So that's an inverse relationship, and also vice versa. So what we saw last year, as interest rates were slashed, bond values went up. Bond funds and bonds, their value went up. This year, as we're trying to contend with historically low interest rates, we know that eventually they're going to have to go up. We saw a little bit of that at the beginning of this year. But what we have to make sure we focus on is how are our bonds and bond funds that are in our portfolios, how are they going to react to rising interest rates whenever that does start to happen? Do we just throw them out and take our chances with the stock market? No, definitely not. What we have to do is think about how our bond funds, like I said, are going to react to rising interest rates, because just like some people's skin reacts differently to the sun, some people are more sensitive to it. Certain bond funds and bonds are more sensitive to interest rate. They have more what's called interest rate risk. It's based on the duration of them. Don't want to go into too many details because that can be kind of boring, but not all bond funds handle interest rate risk the same. So what we have to be careful of is having bonds and bond funds that are really the unmanaged or the passive type funds that aren't handling the potential rising interest rates. They're just kind of sitting there being incredibly lazy, maybe even worse than lazy. This environment and the environment that we're in right now has caused a lot of people, more than probably we've ever seen, to be taking on too much risk, because historically what bond and bond funds have done for people for decades is provide a little bit more stability, diversification, in the stock market. So you can kind of even out the volatility of stocks with bonds. In the past, that's been how it's done, and income. So right now, with this low interest rate environment and potentially the interest rates going up and affecting bonds, people have just kind of thrown the baby out with the bathwater, if you will. That's not necessarily the way to go about it, but people don't know that there's other options out there. And what you don't want to do is take on too much risk just because you're trying to, avoid these type things. And just know that what we're going to talk about today and what we can talk about, with people afterward as well, is that there are other solutions out there, and you don't have to take on too much risk to meet your goals. So that's something to also think about as well. What I'm going to do now is flip it over to my dad, who just so happens to be our founder, Reed Financial Group's founder. And he's going to talk to you about a little thing called inflation. You might have heard about it. And I promise you, after he gives this talk, you will not think about your money in the same way. So Gary, go ahead and take it away.
Thank you, Abby. And it's great to be with everybody today. And if I haven't met you, I hope to meet you soon. And we're just going to talk about inflation, something that we all love dearly, not exactly. But how can that impact your retirement savings and over your lifetime? Because retirement is a little bit of a challenge these days with everything that's going on. And let's take a look at something that I call lazy money. And Abby's already talked about that and how that impacts you. And I also would like to give a shout out to April and Abby, my two beautiful daughters. I couldn't be a more proud dad to have them carrying on the tradition. And of course, Daniel, my son-in-law, who I really think is like a son to me, obviously. I really can't even think about how I could put this in better hands, this company, as we go forward. They're just amazing people. So let's take a look at that chart, speaking of Daniel, and how have things changed? And how can you view your money? And Abby has already talked to you about, quite frankly, how that can affect you from this lazy money. So let's take a look at this chart. Hopefully you can see it, but I want to point out just a couple of things about how inflation has changed things over time. If you look at the price of gasoline, in 1989, if we can remember back that long, it was 98 cents a gallon. Let me repeat that, 98 cents a gallon. That's not very much at all compared to now. And of course, $2.59 in 2019, and of course it's gone up since then. I was at the gas pump a couple of days ago and went, wow, it's going up again. Now coffee, which is near and dear to my heart, has gone up 38%. Now, not as much as the gas, which has gone up 164%, but this 38%, they can't be talking about Starbucks. Because if they're talking about Starbucks, then it's a lot more than 38%, that's for sure. But I still continue to be amazed at how people line up in their cars forever to get that cup of Starbucks. And man, I do the same thing, so I can't really say much about it. I mean, ground beef, and you can see on the chart, in 1989, it was $1.50 a pound. In 2019, $3.86 a pound. That's 157% increase. Now think about that for just a second. I'm now getting Social Security, as many of you are. And I know I don't look old enough to get that, but I actually am. I just had my 67th birthday and feeling very happy about that. But Social Security, last time I checked, hasn't gone up 157% over that period of time. And it probably won't do that. But I do want to just mention one quick thing here, and I know you can't really see this, but recently, of course, because of the pandemic, this is an article that talks about what wood would cost that's a tongue twister, what would cost to build a deck, a 200 square foot deck. Now, I know many of you on the call today are just waiting to build that deck, right? But in 2020, to build that deck, just for the purchase of the wood, it would cost $936. In 2021 of April, just a year later, $3,696 to build that 200 square foot deck. From $936 to $3,696. That is an amazing increase, folks. And with the housing industry going crazy and that sort of thing, we have to think about what could happen as we go along with inflation. Of course, that was pandemic related, but things can happen that can change your financial situation. And so it's important and critical to us to make sure that you don't have something that we call lazy money. So what is lazy money, and how can that affect you in retirement? So if we can go to the next chart, I'd like to talk to you about purchasing power. So if you have your money invested and you're making like maybe 0.1%, and inflation's around 3.5%, how can that affect you with purchasing power? Now, these accounts, I know Abby kind of touched on these before. We're talking about CDs, which I call certificate of disappointment, savings accounts, money market, this sort of thing. And folks, we know why you have it in there. You have it in there because you want to be safe, correct? But the question is, how safe is it if you are losing purchasing power while it's in there? So this example, maybe you're getting 0.1%, maybe it's one of those money markets that Abby talked about, and your inflation's around 3.5%. At the end of 1 year, by having this money in those accounts, this lazy money, it has already lost $3,400 worth of purchasing power. At the end of 5 years, it has lost $18,000, as you can see there, $18,268 in purchasing power. And let me ask each and every one of you on the webinar today, what could you do with an additional $18,000 right now? I mean, I'm sure you could, if you did a lot of soul searching, find a place to use that, correct? You sure don't want to just let it go off in the wind because of this scenario. At the end of 10 years, you can see right there, you would lose $40,000 in purchasing power. At the end of 15 years, folks, you've lost $66,000 in purchasing power by having this in lazy money accounts. At one of our recent workshops that we had, when we talked about that $66,000 number, I saw the wife do this in the husband's ribs, and some of you might be able to relate to that. And she said this, I heard her, she said, that's what we paid for our first home. Of course, you can't get that home anymore, unfortunately, but you see how this type of lazy money is something that it can really hurt somebody in retirement. So if you could just take a moment and let's just put it in your mind, one of your hard-earned $100 bills. If it isn't one of these lazy money accounts, right now that $100 bill, as you can see on the screen, is laying in a hammock with its cute little arms, drinking its sweet little lemonade, just living the life of Riley. I mean, this $100 bill has actually retired more than you have. Folks, this is not okay. You're losing purchasing power. You can see that from the screen. And you really can't afford that when you're retired. So, I mean, we can put that money back to work for you. There are safe vehicles that are as safe as where you have it right now, maybe even safer, that can double and triple your return. They can do it in a tax-favored status, and you can have liquidity along the way. Now, this may be an option for you that you're not aware of. And April, in just a little bit, is going to just share with you how you can find out if this is something that might be a fit or if it's not. But right now, it is imperative for you to look at something that can put that money back to work, because you don't need that money to be in a coma. You don't need it to be retired more than you. It needs to work hard for you in a safe way. And there are ways to make that money safer, to make it safe in a different way. So I'm not going to continue to belabor this anymore, but I will just tell you that lazy money is something that no one can afford to have in their portfolio. And so we're going to certainly talk to you about some options as we go forward. So at this point, without any further ado, I want to thank you for having me on the webinar. I'm sorry if I got carried away. I might be a little passionate at times, but I've seen this over and over, hurt people, and we don't want it to hurt you. So I'm going to turn this over to my oldest daughter, April Cruz. Take it away, April.
Thank you so much, both of you. Wonderful job covering so much material this afternoon. And I'm going to spend some time just sharing with you a little bit about our process. And the first aspect of this, many of you already know this because you've worked with us for a long time. To others of you, Reed Financial Group is new to you. And this is a very important distinction in the fiduciary standard of care. Oftentimes people think that all advisors have a fiduciary standard. And in reality, a lot of different types of advisors, those who are insurance only or who work for a brokerage firm, for example, who have what's called a suitability standard. And as long as that individual is doing what's deemed suitable for you, then they're fully in their legal rights to act in their best interest and their firm's best interest before yours. And the fiduciary licensing and designations that we hold means that we must always act as a fiduciary to you before Reed Financial Group and before any of the companies that we represent. That's first and foremost. And second is that we're independent. And what that means to you is that we truly work for our clients. We don't have a bottom line that we have to worry about, any quotas that we have to meet, or any product restrictions that we must adhere to or are bound by. And we work with a lot of different companies to make sure that we help our clients find the right solution. What we find a lot of is that people don't always have a process in place when it comes to financial decision making. And as Abby said earlier, it seems like everything that could describe the last year or so falls into such an unprecedented, uncharted territory. And that's where we find ourselves yet again with a lot of the traditional safe money alternatives. So I'll share with you just a bit about how we handle that process, helping our clients make sure they have a well-defined strategy. And as a fiduciary, one of the first things that we're going to make sure of is that you have sufficient liquidity and emergency reserves. That's extremely important. There are a variety of solutions when it comes to putting your lazy money back to work. Some of those are fixed, which have no risk to principal. Others of those have a low level of risk. For example, certain types of structured notes that we can use that have a buffer, and other strategies where they are in a low risk, low volatility category. So we have to do an assessment as fiduciary advisors to help you determine where you might have money that's falling through the cracks. That's one of our areas of specialty, whether it's lazy money, whether it's tax strategies that need another pair of eyes to make sure that you are prepared as far as taxes go for your retirement. And also, we make sure we go through a process of elimination, because there is no such thing as a perfect account or a one-size-fits-all investment solution. What might work very well for one of you on this call might be a very different recommendation for the next. So it is a very customized process so that we can help you determine what might be best for your personal situation and helping you with a lazy money strategy if that is something that applies to you. After we conclude the webinar today, you're going to get an email, and that email is going to have both a link to a calendar where you can schedule a time with one of our fiduciary advisors to discuss lazy money strategies or anything else that might be concerning you that you'd like for us to talk to you about. We call this a strategy session. There's not a recommendation that will be made. We'll simply listen to what your concerns are, share with you what it is that we see, and discuss what might make sense moving forward so that we can help you. If you'd like any of the resources or illustrations that we've shared with you today, please indicate that in the email that you receive as well. We'll be happy to get that to you in a prompt manner. And we are here upon Mother's Day. So I do just want to wish all of the mothers that are here with us today a very happy Mother's Day. I hope you have a wonderful weekend, hopefully not as restricted by the pandemic this year as it was last. And a lot of you, because of the pandemic, we haven't seen nearly as much over the last year as we normally do. We're really looking forward to getting back to some live events in the future. And you will also continue to receive additional invitations to our health and wellness series that we are going to continue even as we get back to somewhat normal life and start doing those live events again. So certainly any questions that you have, we're here for you to answer those. The QR code that you see on your screen right now, if you're anything like me, you might have to have somebody walk you through how to use that. You probably have started to see these in restaurants because a lot of restaurants are now no longer doing hard copy menus. So if you'd like to just go ahead and scan that QR code now, what you can do is just pull up the camera on your phone, hold it over the screen there on that QR code, and that will take you right to the link for scheduling if you would like to schedule one of those strategy sessions, or of course you can utilize the email when that comes through in just a bit as well. We hope that all of you have a wonderful evening. Thank you so much again for your time, and God bless.
Thank you all so much. It's been a pleasure to be here with you, and just let us know how we can be of service to you and how we can hopefully help you take care of some of your lazy money. Thanks and have a wonderful night.
Take care.